One of the things that I like to look at with a stock market that's rallying to new highs is to look at the strength of the rally under the surface. And so, what can oftentimes pop up are divergences, and divergences can give you clues about how strong the market rally is and to flash a warning sign that you may want to be careful about how aggressive you get to the long side. Now, this isn't a video to talk about how the stock market's going to crash. It's not one of those. This is just a video that highlights important features that you can use going forward, whether it's today or 10 years down the road, and determining what kind of divergences the market might be showing. Now, it isn't just about when markets are rallying that divergences matter. It is also about when the markets are selling off that divergences can also pop up and provide a bullish divergence. Now, with the stock market rallying at all-time highs, I'm looking at bearish divergences because on the surface, the market's very bullish, but underneath it can actually be developing signs that could lead to a bearish reversal. So the first thing I want to highlight, we have the stock market that has rallied going all the way back to November of last year, late October even. And it has been consistent. You've had one significant pullback during that time, and that was in April. And that pullback lasted about 3-4-ish weeks there. And then you got the pop right off of those lows, and we're back to all-time highs again. So what I'm looking for is, how does this rally compare to this rally? And is there anything that's showing underneath the surface that I should be concerned about? Now, when we had this rally going back to March, we did see a bearish divergence that popped up that led to this, 3 to 4 week sell-off here in SPY. We also saw it in the NASDAQ and the Russell too. So there was a bearish divergence there. Are we seeing anything similar here? And one of the key indicators that I like to look at is the T2108. This is a indicator that's offered through TC2000. You can get a link to it down below, but check this out here. You have a lower high that was formed. A lower high was formed when a high is made and then it reverses, but it's not able to break the previous highs or at least match them before doing so. Now, T2108 can go only to 100% because it's measuring the percentage of stocks trading above the 40-day moving average. So it's not going to go above 100%. It's not going to go below 0%. So I don't really worry so much about it making a higher high. But what I do want to see is whether or not it can match the same enthusiasm as when the previous highs were made. So back in December and January of this year, January when we started making new all-time highs again following the 2022 correction, you can see where almost 80% of stocks are trading above their 40-day moving average. But then you fast forward to March when we were hitting new all-time highs. Where was it at? It was only at 70%. So that's a pretty significant difference where you're going from almost 80%, 78, 79%, all the way down to 70%. And then as a result, you had a significant sell-off in April that took the percentage of stocks trading above their 40-day moving average down to 21%. Where it gets even more interesting, now we're seeing a huge rally unfold in the markets going back to this April lows that were formed back on April 19th. And now you're only seeing 45% of stocks trading above their 40-day moving average. And what's even crazier is that the highs that we're making, all-time highs that we're making right now, that was preceded by a 5-day pullback, we're far below that one too. So technically, we have two lower highs that have been formed since the March highs were formed, which that also was a lower high. So we have lower high, a lower high, and a lower high here. And that's a problem for this market. What it tells you is that there's narrow leadership. Now, what could be the main source behind it? I don't even think I need to pull up the chart for you to be able to understand what's driving this market higher. It's NVIDIA. And so ever since their earnings, it's been on an incredible move. In fact, if you go back to April, it's up over 60% since these April lows. That's a month and a half. A multi-trillion-dollar stock has gone up over 60%. That's going to carry the market regardless if anything else follows. So narrow leadership. You also have other mega cap stocks like Meta, Amazon, Apple, Microsoft, Google. They're all contributing to this rally. But what you're seeing under the surface is also what we're seeing with the Russell 2000, where if you look at the Russell 2000 here, what do you notice here? It's really trading sideways since December. It hasn't moved anywhere. And so there's not a lot of strength in the Russell 2000. So these are your smaller cap stocks, and it shows you that these smaller cap stocks, the mid cap stocks, they're not following the overall large cap indices like the NASDAQ and the S&P 500, particularly the NASDAQ, because it's much more tech centric, and the influence of these mega cap stocks, particularly NVIDIA, weighs far less on it. So when we're looking at divergences and we start to see these things pop up, and we can tie it together why the Russell 2000 is not rallying, and we can tie it together that when we're looking at the T2108 and we're like, holy cow, this is continuing to trend lower, and it's not even getting back up to the previous trend line here like it did back in March. No, it's even weakening at a faster rate. The slope is getting even worse for the stock market when it pertains to the T2108 and the percentage of stocks trading above their 40-day moving average. Now, I'll give you another indicator, and this is the T21.0. This is the percentage of stocks trading one standard deviation above their 40-day moving average. And this is just as bad. Only 25% of stocks are trading above. That should be a lot higher. Like you go back to, again, December and previous all-time highs that we've made in the past, like what we saw in the beginning of 2023, we were trading at 70% of stocks trading one standard deviation above their 40-day moving average. Throughout history, we have been much, much higher. And instead, we're at 25% of stocks that are able to do that, when just in December, we were talking about 68, 70% of stocks being able to do that. In March, we were able to do it at a much bigger clip still at 56% compared to the 25% now. So there is some huge concerns here that this is a rally of just a few stocks. And so the takeaway here isn't to, okay, go sell everything you got and go sit in cash. That's not what I'm trying to say. But what I do want to get across to you is that there needs to be some kind of caution as it pertains to this market. Don't fully trust it. You should never really be fully trusting the market anyways. But when you're seeing these kinds of divergences pop up, definitely a time to start making sure that your plans for managing the risk is in place. If you've got some oversized positions, may not be a bad time to start taking some profits as well. But what you don't want to do is get caught in a bad situation where much of the gains that you've made from the past year is starting to dissolve up real quickly because a couple of stocks that led the market higher are starting to guide the market back down again. If you enjoyed this video, I would encourage you to like and subscribe to this channel. Make sure you click that little notification bell on there. Also, check out my website, shareplanner.com, if you want to learn more about the kind of trading that I do. There's all sorts of good stuff there for you to be able to partake in. And tell me down in the comments below, are you getting a little bit nervous about this market? Tell me why, and what are you doing to prepare for any possible near-term pullbacks? Thank you guys, and God bless.